if you have strong cash flows, you can always refinance your loan. Always. You'll always have options. If you have weak cash flows or no cash flows, refinancing is very, very, very tough. And so you might not be able to outlast these deals or outlast these down market cycles. So just understand that when you're investing, most of the time your cash flow is kind of a defensive metric. The more return comes from cash flow, the more or the less risky investors will generally consider that deal. And it doesn't mean that you're going to make a killing off of your cash flows. You're generally still going to make more on the appreciation of the asset or the forced appreciation, but it's a defensive play.
If you're a real estate agent earning $200,000 a year and you want to grow your passive income, this show is for you. Learn secrets other agents use and hear from experts in our field who will guide you on your journey to investing in assets like apartment communities so you can take your commissions and turn them into cash flow. Here's your host, Randal. Let's dive in.
All right, welcome back. I am excited to have this conversation today with my guest, Justin Moy. Justin he runs the President's Club Investors, and he has a lot of strategies for building your passive income up and how to retire quickly. So he works with a lot of real estate professionals, sales professionals, and he essentially has a fund and he does a fund to fund. So every time there's a deal that's out there, he's raising capital for that deal through a fund structure. And so we go into the details on that and how that works and what he's seeing in the market, how he vets sponsors and all of that. So we're talking multifamily asset class today, and we are talking funds, how they're structured, the market overall. So tune in, perk your ears up, get your notepad out. He's got a ton of information. You're going to learn something from it. So I hope you're getting value out of the show. If you are, please go on, rate and review wherever you're seeing this. If you can give us a comment, one word or more, helps us out a ton. Bring on awesome guests just like Justin. So let's jump into the episode right now.
I'm big in lifestyle design. I've wanted to be a digital nomad since I heard of the concept.
Yeah.
So I've always known I've wanted to have flexibility. That's actually what made me transition from kind of real estate agent to more on the investing side. Is obviously real estate agents is very, very hyper local. And I realized I wanted to move around a lot, whether it was in Latin America or just kind of move around within the States. I know I wanted that flexibility. And so I started kind of creating that lifestyle. And this is the first, month that we could do it. We could take the plunge. We committed to doing, the rest of the year. So we've got 6 months in total.
Fantastic.
In Latin America. I'm fortunate that now, the business is in a spot where I can do that and I can work 100% remotely. And I'm not too far from the States if we have emergencies or something like that. It's pretty easy to hop back on and go. I like traveling, so it's not that big of a deal. So it's just kind of lifestyle design, man, just like you said.
Interesting, man. So you went from brokerage to investing, and what kind are you doing? Syndication mainly or capital raise?
Yeah.
Or where are you in that?
Yeah. So I do fund management for syndications.
Okay.
So I don't operate deals anymore. I underwrite deals just kind of in part of our due diligence, but I used to underwrite full time. Then I did asset management, was my full focus in the business. And then over the past 4 years, it's just been fund management.
Okay.
So, and I've known this was kind of my North Star from the start, but getting started in the business, I felt like I wanted to have a really good base in underwriting and financial modeling and how, assets are managed and ran, what's it like to, I've lived in the complexes that we've managed. And things like that. So I've always known it was a means to an end of making me hopefully a stronger fund manager and being able to invest better with both my own money and our investors' money. And so I'm kind of at that culmination point where I'm doing the nomad thing, I'm fund managing, which plays into my strengths way better. And I'm just like I said, design it all out.
So fund management, and you can break it down in almost 3 different things. Like you have a capital raiser, you have an asset manager, and then you have a fund manager, right? So,
sure.
So it's interesting that you have gone through the gambit, I guess, of all 3 of those things. Did you do stuff on the asset management side and the operator side?
Yeah. And I think you unless you have a different business model that I'm aware of, I think most of the time people consider the buckets to be like acquisitions, which is a lot of underwriting, managing banks, loans, all that stuff, and then asset management and then fund management. So, and for me, fund management means raising capital. That's what I do. My primary focus now is 2 main buckets is I raise money and I do due diligence on the opportunities that we get.
Got it.
So, I we see about 30 to 60 deals per month. We typically do about 2 to 4 deals per year. So a
Yeah.
lot of due diligence process, and a lot of that comes from, yeah, my time in asset management. So, I managed C-class properties and all the glory that comes with that type of job, and working with tenants in that sphere. But yeah, asset management was a big part of it. And I knew it wasn't what I wanted to do long term, but it's made me look at deals in such a different way that a lot of people who go straight into fund management maybe don't have those types of reps. So I think it was effective in the long term, but it's definitely a different set of skills for sure.
Yeah. So, all right, tell me then, when did you get out of, I guess, the brokerage side of the business, and what did that business
Yeah.
look like? How long were you in
Yeah.
it? Like,
Yeah.
and then you transitioned into what asset class? Multifamily?
Multifamily. Yeah.
Yeah.
So I was very fortunate that I stumbled upon real estate as a career very, very early on. I was 17 years old looking for my first like office internship. I was sick
Mhm.
of working, till midnight at the grocery stores and sports stores that I worked at. I always knew I was very good at sales. I worked at like GNC. I was like the top salesperson in the nation. Like every week, I sold home gyms. So in a
Slinging
retail
a
sales
lot
environment,
of vitamins, man.
yeah,
He's
that's you
like,
got to sell a lot of vitamins, man.
yeah,
And I
dude.
was in the mall, so I was hustling. There was a lot going on. But I always was good at like retail sales. My very first like retail sales job was selling like shoes, and I would get bonuses for like shoe inserts and stuff like that. And so I was confident enough that I said, hey, like, what's the bigger scale thing? How can I make a career out of this? And naturally, I always had this kind of interest in real estate. So when I was 17 years old, I started looking for internships, started looking for office experience, landed an internship at a commercial real estate company. That company's called Cassidy Turley. It's been bought and sold many times. I think it was ultimately bought by like CBRE or something like that. But it was a small office. I was helping brokers with their investment decks, with their underwriting packages, ordering stuff for their presentations. Just like random stuff that you do with an
Mhm.
office that an intern does. And I just got super addicted to watching them and just looking at their careers. One thing that really intrigued me is they were in and out of the office all the time. I kind of thought to myself, man, I don't want to sit in an office all day. It's kind of stuffy in here. It's kind of boring. So they were in, they were out, they were having lunches, they were celebrating big closings. And I just thought this is so cool. Like this is nothing like I thought an office job would be. My mother hates her office job. And so I kind of had these low expectations. And when I saw everybody was kind of fun and having a good time, I thought this is what I want to do. So I got my real estate license when I was 18. This was in the Bay Area of California, where you don't need to sell commercial properties to have seven-figure listings. So I went on the residential side. I loved it. After about 6 months of batting zero, I started to kind of get my feet under me and had a good journey there. I did that for I say about 6 years in total, but I went into the military for a short stint. I went to college for a little bit. So I was always kind of involved in the business, but full time, I'd say it was about 4 years.
Yeah.
4 years. And then after that, went to multifamily.
Yeah. I was gonna say that was what, 4 years ago? You look like you're 22. How old are you?
Yeah.
He's
I'm
like,
going to be 31 soon.
yeah, right
So
on.
I'm going to
All
be
right.
31. Yeah, I got good skin, I think.
Yeah,
People
man.
say.
Yeah, it's solid.
Yeah.
Uh, so, all right. So you transitioned and you went into, how did you get out again? What was the catalyst of getting out of the single family residential
Yeah.
brokerage side?
Yeah. I loved being on the real estate transaction side. I think it's so cool. Even to this day, people ask me like, what should I do if I'm interested in real estate? I'm like, dude, become an agent. I think you get to play in so many aspects of a deal. You get to see transactions. You get a little piece of every part of the transaction.
Mhm.
So you don't really specialize, but you get good enough at every aspect of the business that I think it's a really good stepping stone to anything that you want to do in this space. If you have kind of what it takes, right? It's commission only. It is hardcore direct sales. You own your own business. So, there requires certain strengths of somebody and a certain thickness of your skin. But if you can manage those things, it's a very good entryway into the business. Now, ultimately, what made me realize I wanted something new is this was a very, very, very specific moment in my career. For whatever reason, I was getting really, really burnt out. I was working a ton. And you see me, I don't know if you'll post the videos. I have a super thick head of hair. I
Yeah.
actually started going bald. I was
Oh yeah.
super stressed out. And that's, my I was living at home still at the time because, I'm 19, 20 years old at this point in the Bay Area. And my mom's like, hey, you got to figure this out. I mean, you can't be going bald. You're stressed out. You're not sleeping anymore. Always loved the gym. I wasn't going to the gym anymore. And she's like, dude, you just got to like figure something out. Why don't you take a day or two off and just think about what you want? And I said, okay, fine. So I was sitting at home during the middle of the workday. I had a college football game on TV, and I was just thinking, what do I want to do? And at that point, the camera had panned over to like the student section, and everybody was going crazy in the student section. They were having like a super good time. And I just thought to myself, man, all of my friends are in college right now. They're kind of going through a certain path, and I'm in my hometown. If I set down roots here as a real estate agent, it's hard to pick up and move. You can be very established, but you can't really take your book of business with you. And in that exact moment, I kind of felt like the walls were closing in on me. And I don't know if panicked is the right word, but I kind of thought, okay, I'm going down this path that's very, very specific. And I don't know if I want that right now. I might want some of that flexibility. So, I took the rest of the day to think of what can I do that's still in the real estate space that gives me that flexibility, that lets me move around, that lets me do different things. And naturally, I worked with a lot of real estate investors kind of accidentally. So now that rabbit hole started. Then it turned into bigger properties. And, next thing we know, we're doing, only about 200 unit plus apartment buildings. But it was a very specific moment in my career after a big bout of burning out where I just thought, dude, I got to change something like right now. What's my new
Yeah.
trajectory?
Yeah. Good for you for having that introspective moment, because yeah, you can easily burn out if you are running
Yeah.
through a ton of transactions or stressing out about a commission or something, because
Yeah.
it is a boom and bust. I'll second your advice that you're giving people starting in the business of starting at as an agent of some sort, just
Mhm.
because if you want to invest, I mean, if you buy the wrong property, you most likely are going to come out okay if you bought it right, but you could lose
Yeah.
money. And if you go into it on the agent side and you work with investors, you get to de-risk your learning. Like you can see
Yeah.
what they do, learn what they're doing, learn what works. And if you work with them, you can see a lot of transaction volume by doing that.
Yeah.
But
You can
yeah.
also see too, like the headaches of it, right? Like
Oh yeah.
I sold a lot of homes of people who were very, very, very successful real estate investors who were just like, dude, get this one off my books.
Yep.
Like I'm done. And for whatever reason, those things happen. And so it's not always this Instagram passive income, buy 15 houses a year kind of thing. Like there's a ton of work that goes into it. And
Yeah.
that's a big piece of my educational content is like, don't invest in properties for passive income. There's certain strategies you can do for passive income, but if you buy property, that's not passive. You're buying a
Yeah.
job. You got to
Yeah.
work it.
Right.
So naturally, I work with a lot of salespeople and a lot of real estate agents who understand that, thankfully. But it's not always super glorious. And so when you're a real estate agent, you get to see all of those things. You get to see the big exits that somebody's going to sell like a home flipper like you for massive profits, and you get to see the guy who, this is a real story, who a tenant poured cement down the drains and the home
That
was
has happened to me.
almost worthless. Yeah, crazy to think. I mean, nobody talks about that on Instagram, right?
Yeah.
This is the worst passive income ever. You got to
Yeah.
get dig through the ground. I mean, break up everything.
Yeah.
So you get to see both sides, and you kind of get to decide if you want that life or not.
Yeah, that's funny. 'Cause like you mentioned that, I literally was at a lunch with some high school buddies yesterday. They're like, "Hey, what are you working on? Are you doing any Section 8 housing?" I was like, I was." And then this one thing happened and I never will again, probably
Yeah,
soiled the whole bunch just because, yeah, once they lose they know that you're going to like report them for not
yeah,
paying rent, then they're like,
yeah.
okay, just burn the house down. Doesn't really matter.
I know.
And they
Yeah,
poured cement down the deal. Oh man, it was luckily a pier and beam house, but it was like, nightmare.
yeah,
Um, that's funny. Okay, so let's talk then on multifamily, and I'm just kind of curious. So when did you start? Like, what was the year that you were kind of making a big push into that world? Because it's a
yeah.
much different time now than it was
Sure.
2020. Yeah, so I don't know
Yeah.
when you started.
Man, no, it was, at this point, that was pretty much right after I had started wrapping up my full-time career in the broker. So, I got my license at 18. What are you, 19, 21, 22, about 20, 23, 24, let's say. So about 6, 7 years ago.
Yeah,
And I wasn't all in right away, right? There's a learning period where, I underwrote a couple deals, but I knew I wasn't going to buy something in the near future. I was talking to brokers. I joined some groups. I paid for mentorship programs just to really see if it's what I wanted to do. And so I'm not, I wouldn't say that I hit the ground really hard at that point, but I started easing into it. And then, over the past, about 4 to 5 years has been really, really heavy into, fund management and, coming after acquisitions and coming after underwriting deals. And it's interesting you mentioned, Section 8. The very first deal that we bought was a Section 8 play.
Yeah.
And looks great on paper. And that was the first deal that I asset managed. And,
Like, wait, are you going to make me seem like the bad guy here? Or what just happened?
No way. I mean, it's tough. On paper, it seems great because in this market, Section 8 actually paid more than market rent. And so the sentiment is, hey, it's above market rent. It will always be full.
Guaranteed, guys.
Guaranteed payments. It will always be full. There's a wait list for Section 8. And while those things are true, it has its own unique set of issues and things that you got to deal with. So yeah, it's I would say, this was about maybe 6 or 7 years ago where I started kind of getting my feet into it. And then it took me about a year or so of kind of hemming and hawing in it before I really dove in and hit the ground running on it.
All right. So let's talk then. I don't know what kind of fund is it a fund or explain to me the setup and structure that you got, because fund of funds or whatever it is, I don't know.
Yeah. So fund of funds is a word that people will use, special purpose vehicle. I think a lot of people, when they hear fund, it gives off maybe what we're doing, maybe not. A lot of people, when they think of a fund, they think of, hey, I'm going to give you money. You take that money and do whatever you want with it. Hedge funds are pretty common, or like a Fidelity or a Schwab or something like that. Our fund is a little bit different. We don't do what's called a blind fund, which is kind of that scenario where, hey, you give me your money and I'm going to kind of buy what I think is a good opportunity with it. We do individual funds for individual opportunities. So, let's say you're, flipping a house and it's a big project, you need $1 million. You might come to a guy like me and say, hey, Justin, we need $1 million for this deal. If you and your investors are interested in it, I'll give you special terms, because now instead of you having to go find $1 million, I find that whole $1 million for you. There's usually some preferred terms with that. And then I can pass those preferred terms down to our investors. So you do that at really big scale, and you get to have access to a seat at these big tables with other 7-figure check writers, even if you're not writing a 7-figure check yourself, because we kind of pool money together.
Yep.
So that's what we do, fund to fund or special purpose vehicle investments, or kind of words that people might use to describe what we do.
So typical check size and asset, that are you class A, class B? Like, what are you mentioned 200 plus units.
At this point, if we're going to do a class C, it's got to be like C+++. It's got to be pretty much right on that cusp of a B.
In an A neighborhood.
Like, yeah, exactly. Yeah, that's what everybody says, right? This is a C in a B neighborhood. Like, no, exactly. But it's got to really, really be on that. So we will do mostly hanging around the class B areas, typically 200 plus unit multifamily, but I would be okay going lower unit counts if there was other scale. The reason why we want 200 plus is you can really scale your staffing. But if you have a 100-unit apartment down the street and you're going to buy another 100-unit apartment, a block away, okay, you kind of get the same scale. So we're less strict on that and more strict on, hey, we need to see certain level of scale that we can achieve right away. 200 is kind of typically is that magic number. We like B areas. We don't like areas where we don't like apartment buildings that police are familiar with. So that's actually part of our due diligence process. We actually call the police department there locally and just kind of ask them if they've been there, when's the last time they've been there, kind of what goes on there. We don't like places where people don't have jobs to support themselves. We like to see cars gone during the day, and people busy at work, and come home at kind of typical times, and just have a good routine. So there's certain due diligence like that we look at in a deal, but we're pretty much in class B neighborhoods and apartment buildings right now.
Yeah. And in check size, what are you guys typically looking at?
Yeah.
200 unit, what is it?
I mean, it depends. We just wrapped up a deal in Jacksonville. It was about $25 million, check size about $12 million.
Yeah.
We did a deal in Dallas before then, $40 million deal, $20 million check size.
Yeah.
So, we might not do the whole 20 million or 10 million, but, we'll be a part of it. And I'd say for most people, you hit the best scale when you hit to about the $2 million mark.
Yeah.
So whether you invest in a fund like ours, where we're going to go and commit $2 million to a project, or you're an individual, just ultra high net worth guy or girl who can write a $2 million check by themselves, that's probably where most people are going to see the top level kind of returns, where you can really negotiate some really strong terms and make out pretty well ahead.
Yeah. So you're typically going into a syndication deal, right? They need in the
Correct. Yeah.
capital stack 20 million cash equity
Sure.
position, right? And you're coming
Yeah.
in with two, just to explain it and break it down. You're coming
Yeah.
in with two, and you're able to go to the sponsor who brought the
Mhm.
project and say, hey, look, we're writing a big check. We need a side letter or side agreement that you may
Yeah.
be offering a 70-30 split with your people on a 7 pref, but we need a, like, what do you typically
Yeah.
see?
Yeah. So we're very fortunate that at this point, good track record and good reliability. So typically we're looking at either an 85-15 or maybe a 90-10
Yeah.
with some additional preferred return as well.
Yeah.
So, if you're going to go invest directly, you might get, like you said, a 70-30 split, let's say a 6 pref.
Yeah.
Our fund is we're going for like a 90-10 split with maybe an 8 pref or a 9 pref.
Yeah.
Now, part of that is how we make money, right? Is we take a little bit of that difference. But for us, there's always going to be benefit, whether it's in better terms, whether it's in higher equity split, whether it's in a safer equity position, or something with our fund that is more advantageous to the investor. So it's
Yeah.
not like we're just a middleman who is, holding deals hostage. We are negotiating some type of better economics for our investors. That's going to be an additional benefit to them.
Yeah. Yeah.
So
Yeah.
yeah, there is an economics there. And then, we get paid, of course. There's a bit of a difference there that we can take home as our payment for, our time and our
Yeah,
efforts.
for sure. So what kind of fund is it? Is it 506B, C, crowd
We
fund?
do a
Is it?
mix.
Yeah.
Yeah, we do a mix. So we like to do accredited and non-accredited deals. In my ideal world, we do about half and half on the year. Doesn't always work out that way. But, I think the accredited designation is so foolish. I mean, on one hand, you have some people saying that figure hasn't been adjusted for inflation. And at this point, if you do kind of feel like that's an important metric, $1 million net worth or $200,000 income, the real income now I think is like 500,000, and the net worth is closer to 3 million. So there's people talking about updating with that, which kind of wipes that type of fund out. That's not
Yeah.
that many people. And then there's other people who say, hey, and I'm in this camp, you know, what you make and what your net worth is doesn't mean you're more or less sophisticated than somebody else.
Correct. Yeah.
There's somebody out there who studies real estate, knows what they're doing, who's more well versed than somebody else who maybe just because they're an engineer, have a high degree, they make good money. So I don't agree with it, but there's still kind of the rules that we have to play by. But yeah, we like to do both.
Yeah. This educate me on this. Okay. So, and a syndication comes up and it's a
Yeah,
506B offering, right? No
sure.
advertisement. You go out.
Yep.
Can you do a 506C? Because your vehicle is a fund, right? So can you do you
Yeah.
know the answer? You
So
know what I mean?
yeah, so think of it this way. If a syndication comes out and it's a 506B, so there's no advertising, you can take non-accredited investors. We will have to honor what that sponsor structures their deal as.
Got it. Okay.
So I cannot say, well, my fund is a 506C, so I'm going to go advertise.
Mm-hmm.
No, because we at the end of the day are, from a legal structuring perspective, one big limited partner.
Yeah.
So we're one big investor. So we cannot bend the rules around the deal. We will honor what the deal does.
Yeah.
So no, it's going to be even throughout.
So if you had 20 non-accredited
Mhm.
sophisticated investors, right? And that out of the 30, 33 or however many you
Sure.
can have in there, does that
Correct.
count against the lead sponsor's number? Do we know that?
That's an interesting kind of
Do
gray
we know the
area.
answer to that?
Some lawyers say no, some lawyers say yes, because that's another benefit too, as to why a lot more sponsors are now running it this way, because there's some opinions that say no, those do not count. So the way that they see it is almost like a little loophole, like, man, we could have these funds, it's just one, but really within those funds there's more. Then there's
Yeah.
other lawyers that will say no, you can't do that. So in these scenarios, sponsors tend to hire the lawyers who have opinions that they align with. And so, it's a bit of a gray area. So that's something
Yeah.
that hasn't really been worked out that well yet. I'm sure we'll kind of have some changes in regulation here at some point, but it's tough to make that happen having that 30 cap
Yeah.
period,
Yeah.
because
Yeah.
every fund is going to have, a couple, so I imagine they'll hopefully treat it just as one. But yeah, it's a little bit of a gray area. There's a little bit of
I
division.
imagine my take on it, if it hasn't been worked out in the courts yet, it only will work itself out or become an issue if deals start falling apart and
Right.
investors get upset, and then
Yeah.
that's
Yeah.
when that will
Yeah.
come to light.
And then it's always more regulation after that, right? So
Yeah.
they probably will say, no, you can't do these.
Yeah.
So and then there's also regulation that's been proposed to go away from net worth and go into some kind of test or some kind of
Yeah.
aptitude or educational test that you can take just to show that you're not getting, swindled out of your last 50 grand or something like that, that you kind of know what these are, and then you have a certificate. But so, maybe it won't even matter in a
Yeah.
couple of years. I personally think that way is better than some kind of income figure that to me doesn't mean that you're more sophisticated or not.
Let's move in since you're doing the capital raise. So when you first said fund manager, I also was thinking okay. So in my mind, you have capital raiser and a fund manager. So the fund manager is almost running like the auditing the files, making sure that everything's there, make sure distributions are
Sure.
happening. All of that stuff is
Yeah,
that's the fund manager's job.
I see what
Um,
you're saying.
so like, what do you? Let's talk more, I guess, nuts and bolts of the business of
Yeah.
raising capital. What are you doing right now to attract investors?
Mhm. Yeah.
Uh, being especially that you're traveling,
Yeah.
awesome,
Yeah.
having an awesome time overseas and doing
It's
things.
it's so interesting because I'm actually meeting up with somebody who I had an investor call with tonight. We're having dinner
Nice,
together. He's in Costa
nice.
Rica. So, I don't think you should let those things hold you back. Personally, I'm very introverted. I've always been. So to me, I don't really thrive in environments where I'm networking or in conferences, or, I do go to those things almost out of necessity. I'm usually not like the first one there, the last one to leave. I'm very introverted. So I tend to do really well doing things like this. Like I really like doing podcast shows and doing our own podcasts. Our show is called Passive Real Estate Strategies, which is all about syndications and funds and being a passive investor in deals. Those have done really well for us. I'm very, very active on LinkedIn. You can always look me up on LinkedIn. I post every single day. I engage a ton. I message a lot of people there. So to me, those are the two biggest avenues beyond, referrals and kind of people that I've already known to bring on like net newer investors. And they've done really well for me. And thankfully I can be anywhere in the world and do those things just like I do now. So again, it's a design thing, right? I saw a lot of people do rely on conferences to get a lot of investors, but I know I like to move around. I like to travel a lot. So it's about picking the kind of avenues that work for you and that you can commit to for the long term.
All right, let's say we've got and somebody who wants to transition into being a capital raiser on, again, just super nuts and bolts. You're posting every
Mhm.
single day on LinkedIn. Let's just take that one
Yeah,
avenue and that
sure.
one lead source in the funnel. What are you seeing is getting the most type of response? So
Yeah.
is your goal, I guess, break it down for us. Is your goal to like
Yeah.
grow an audience and then when you have an offering, then just push it to the whole audience? Or are you
Yeah.
specifically, yeah, break it down for me.
So, I don't have this massive audience, right? I actually just made a post today. I crossed over like the 4,000 follower mark, which on LinkedIn is a little
Pretty
bit
solid.
more esteemed than, like on TikTok, I think I have a couple thousand, right? But like it's not as focused. So, I don't think the goal is to build this massive Grant Cardone audience, right? Where I have millions of people looking at me. The goal is to build a small following. People who resonate with me and my message, because of my background in sales, they tend to be salespeople. Real estate agents use a lot of LinkedIn. B2B salespeople use a lot of LinkedIn. Our company, President's Club Investors, that's kind of a big sales moniker. So it's salespeople who specifically fit into one of two categories. They either want to be work optional faster, so they don't want to work until they're 65 or 70, whatever the age is going to be at that point. They're always talking about raising the age limit to working, or they have fully optimized their conventional retirement strategies, which are like their 401ks are maxed out every year. They have some fidelity stuff maybe, and they have cash left over, and they're always thinking like, what's the next thing? Like, how can I keep building on this? Then they kind of come to us. So when it comes to posting, when it comes to having that, like you want to just have a very clear message of who follows you. Because if I'm just Justin, the real estate guy, there's 2,000 real estate guys and girls on every platform. I mean, you can't stand out. So to me, I have a few kind of layers, I guess, of people that tend to be attracted to our message. And when you think of it that way, I'm kind of an audience of one because there's a lot of capital raisers out there. There's even fewer that specifically cater to salespeople and understand why we would want to invest in stuff like this. There's certain risk mitigation strategies when you're commission based that, in my opinion, you should invest differently than somebody who's maybe an engineer who makes the same salary every year. And then there's even fewer people who speak to sales professionals who want to be work optional fast. The goal is to replace a high income fast. So you really want to figure out who your message is going to resonate with, and understand that if you're talking to everybody, you're talking to nobody, and really get narrowed down and focus in. And then you can, that guides your post, that lets you know what kind of podcast to put out, that lets you know, what do my people want to hear and what do they like to see. That really helps with like a lot of the content creation, a lot of the marketing, stuff like that.
Yeah. Yeah. Build your avatar. I agree with that wholeheartedly.
Yeah.
Awesome advice.
Yeah.
So, okay, now you've built your avatar, you're targeting them. They're interacting with your posts. What are you doing to convert them into, like, what does your
Yeah.
sales cycle look like from somebody responds to you on LinkedIn? Hey, cool post, man. Awesome. I agree with you
Yeah.
100%, to like,
Yeah.
hey, I've got this offering and I need $50,000 check. Are you in?
Mhm.
What does that look
Yeah.
like, that life cycle?
What's so interesting is I learned this when I was in real estate sales. And I don't remember where I learned it from, Tom Ferry or something like that. Essentially, there's two ways to build a business like capital raising, like real estate agent or whatever it's going to be. The first is speak to a ton of people on some kind of massive stage. This is like the Grant Cardone method. Well, Grant Cardone's got thousands of investors. He makes posts. His whole shtick is marketing. If you invest in one of Grant's deals, like you're never going to call Grant Cardone and be like, "Hey man, how's the deal going?" Like he has this massive, massive, massive stage that he stands on, and he talks to a bunch of people. The second way is thinking of growing your sphere of influence, right? People, like your friends and family, people who really, really, really know, like, and trust you, people who you would have dinner with, and really growing that sphere out, pulling people closer into the center of that sphere, from never heard of me to this guy's kind of interesting to we've met to I've done business with him or her to like I got to tell my friends about all this. On one hand, you can create this massive marketing machine and make big teams. On the other hand, you don't really need to do all those things. I don't have a big team. It's me and I have a virtual assistant. I know every single investor that I transact with. I'm on a text message basis with every single one of them. I know their face. I'd recognize them in the store. I don't want this massive, massive audience. I want a close following of people who really, really bought into what we do and we're on the same mission together. So for me, it's all about messaging and getting the conversation offline. If you came to my LinkedIn profile today and you liked one of my posts or you commented or something like that, I would DM you tomorrow. And I would just say something like, "Hey, Randall, thanks so much for engaging. I really appreciate it as I'm growing my profile. What brought you to my profile? How did you come across my profile?" And just see what happens. People say all sorts of things. Those conversations tend to go into, "Yeah, you're kind of interesting. Like, what exactly do you do?" And then, you have this tiny little pitch. And hey, if you're interested, you want to carve out 15, 20 minutes just to get to know each other, see if it's right for you. So just bring that relationship offline. And that's really the method that I use. So I'm not looking to build out this massive, Grant Cardone or Alex Hormozy platform. I want a very intimate platform and following of people who are really bought in. And that's the way that I structure my business.
Yeah, that's awesome. That said, we talked a minute ago about lifestyle design, and it seems very
Yeah.
much in keeping with the way you have structured things and the way you want things to happen.
Yeah.
So how did person here in Costa Rica that you're meeting for dinner, is it, were
Yeah.
they just happened to be in Costa Rica at the same time, or they were, you're getting investors
Yeah.
from all over?
No, no. So American, so we do only work with American investors. I don't know the nuances of getting foreign capital into deals, different tax implications, different legal implications. We don't do that.
Yeah.
So yeah, this is a guy who I met on LinkedIn, just literally the same path that I just laid out now. Engage with my profile in some way, just met DM for a couple of times. And then, when I started sharing my journey, "Hey, I'm in Costa Rica. This is why I invest. So I can do X, Y, and Z." Was, "Hey, I actually go to Costa Rica a couple of times a year because he has some work out here. The company is in America and in Costa Rica." And then it just came up, "Hey, I'm in Costa Rica this week. Are you free this day?" So it's just so interesting. I would never have thought that something like that would happen. Like, what are the odds of somebody I meet through LinkedIn being in Costa Rica, being interested in what I do, having an investor call with me, and then meeting up for dinner? So it's all, things just happen in these weird cycles, and everything happens for a reason. So it's not normal that I don't target people in Costa Rica or something like that, or like where I'm
Yeah.
going to be vacationing or something like.
Yeah.
But
Yeah.
yeah, it just happened that way.
Yeah. Nice. All right. One more thing on LinkedIn then. So
Yeah,
is there a type of post that you, or set number of different types of posts that you are going for, again, on the tactic side? Like, this is a
yeah.
personal one, I have to do it by 9 a.m. And then, or
I
is
don't
it just
know.
more organic? It's like,
um, It tends to have a certain schedule just because I have a typical daily routine. I'm not super picky about, when the posts go up, but again, they tend to go out, generally at the same time most mornings.
Mm-hmm.
I happen to do text-based posts. I don't do a lot of videos. I don't want to pay somebody to edit it. I don't want to edit it myself. I don't, I don't personally engage with a lot of videos. I like to skim things. So to me, it's just finding the thing that works for you. If you love to make videos, I love to do podcasts. I love to talk, but to me, I don't want to edit videos and I don't want to deal with uploading them and I don't want to deal with different software. So to me, I just write. I like writing and it just kind of works for, again, the longevity. If you're going to go down a path of any type of business you want to build, you have to put yourself in a position for longevity. So to me, that's the biggest thing. So I write, one post a day. I write one day a week. So I have most of the posts figured out in the morning when I'm going to go post it. And then by that point, it's kind of copying and pasting or maybe making some slight updates. But no, it's a pretty simple formula.
Yeah.
I do my best to keep things pretty simple.
Yeah. Awesome.
Myself.
Okay. All right. We'll leave LinkedIn now. Again, I like getting in the weeds with certain
Yeah,
things just so that somebody that is listening and thinking about, oh man, I should really, start raising capital for X, Y, and Z or whatever it is. And
yeah,
this will speak directly to them and they can use some
yeah,
one strategy at least, to
yeah,
start building
definitely.
that funnel. Okay. So I mean, we could talk about the market, man, because I'm kind of curious what you're
Sure.
seeing now. You said you're
Yeah,
seeing 30 deals a month, buying 4, right?
yeah,
And so you're also in an interesting position where you are allocating capital.
hmm,
So you're not only vetting a deal, but you're vetting a sponsor.
yeah,
So I've had a number of conversations with fund managers doing similar things, but I'm curious your
hmm,
take on just some cursory level due diligence that you have to do on sponsors and kind of who you're
yeah,
looking for to partner with.
yeah. So, man, sponsors, that's really where a big chunk of it is, right? You want to make sure that you have a good amount of due diligence on there because it's the old saying, a great sponsor can make a bad deal good, and a bad sponsor will make a great deal bad.
Yeah.
So that's a big part of it, and I think that's actually a really big relationship building phase of it. So the last deal that we did, it was a deal in Jacksonville, and it was a relationship we were been building with that sponsor for over a year. And they've had many deals over the course of that year that we just weren't really comfortable with yet. We were kind of watching them, seeing how they reacted to things, seeing how they've reacted when deals have not gone as planned. Which every deal doesn't go 100% as planned, but I mean in a lost capital scenario.
Mhm.
What kind of things did they learn? How did they communicate with their investors? Were they pulling out all the stops, including their own money, to preserve investor capital? A lot of those things I really like to focus on. How have you responded in down cycles, and how you responded when deals have gone sideways in a lost capital event? And what have you done to die on your sword before you had to go to your investors and say, hey, we either have to cash call or we have to unfortunately lose some capital on this deal? That's a really big portion of it. Other things I look for is what does the actual team look like? Personally, I don't invest with individual operators. I like to invest with companies with formalized systems and teams, at least 20 full-time US based employees, because I like to see, I watch a lot of Shark Tank, and Kevin O'Leary has this saying with solopreneurs. He says, what happens if you walk down the street and get hit by a bus? What happens to my investment then? It's unfortunately some of the things that we have to think about. So to me, size matters. And that's not always the right answer for everybody, but that's the right answer for us. Financial ability matters of both the named partners on the deal and the company itself to be able to outlast and put up capital when things are needed. Organizations, operations, I like to see a system in place. I don't
Mhm.
want to see a side hustler or a solo guy or girl who's just kind of winging it.
Yeah.
I like to see that. Track record is of course big. Everybody's got a good track record over the past couple of years, so I look a little bit deeper than that. I look at the markets that they're investing in, why they're investing in it. I really want to know how they think. I really want to know why they picked this business plan, or why they picked this property, or why they picked that market, and see how thorough those answers are. You'd be surprised. Some people are willing to throw down seven-figure checks and be, I don't know, it's a good deal. My friend's doing it. And there's just no due diligence to it. So I like to see how they think. And that part takes a lot of organic getting to know somebody, and then some formal sit downs and some formal questions about deal specifics or company specifics, things like that.
Yeah. All right. You mentioned something. One, great advice. Like across the board on all those things. Definitely take that to heart if you're going out and you're trying to find a sponsor to invest with. Do those
Yeah.
things. One thing that I want to drill down on is you mentioned, look, it's a down market. Certain sponsors losing money on deals. How are they handling it? And you said you want to see how they have handled that communication. How,
Yeah.
if I'm an individual LP coming into a deal, not a $1 million, $2 million check writer, how am I going to
Sure.
have that due diligence or that access
Yeah.
to how that sponsor's handling the communications on a deal maybe
Yeah.
they don't necessarily want to talk about, you
Yeah.
know?
That's a little bit tricky. I can't speak for how all sponsors will handle that, but what I can say, very broad strokes in a business perspective, is we work with great sponsors who have access to a lot of capital. Great sponsors always get a lot of capital for their deals. If you're an individual retail investor and you have a $25,000, $50,000 check, it can be more difficult for you to get these things, just from a time perspective. And I'm not saying it's because you're a bad person or you got to bring more money to have more value, but at the end of the day, kind of, right? Because if you're raising $50 million easily every year, and then somebody comes in with 25,000 bucks and is asking for a laundry list of items, I don't know if there's a lot of motivation to bend over backwards for that person. But again, we're coming in with 7-figure checks. Yeah, we're going to get all the due diligence that we need and want. So it's tough if you're an individual investor. You always want to ask those questions because, again, that also tells you, if they're kind of brushing you off because you're a small check writer, that's probably not somebody you want to deal with anyways. So from a business perspective, yeah, it might be hard. You might have less leverage than we do to get different answers, and you might have less knowledge. Like, you might not know to ask for these things. You might not know to ask, like, hey, do you audit your financials or not? You may not even know what that is. So there's a knowledge perspective, but there's also a leverage perspective where if we ask and we're bringing 7 figures to the deal, we're going to get 99 out of 100 requests that we get, unless it's way overbearing or something like that.
Yeah.
But yeah, it's hard to leverage your way into those situations. That's another benefit of kind of a fund like ours. But when you ask these questions to sponsors, part of what you're looking for is how they respond to it. Everybody has deals that went sideways, but if you're open about it and you're willing to share and you're willing to share what you learn, that's better than just saying, yeah, let me get you that info later, and then just never hearing from you again.
Yeah. Solid advice. Okay. All right. So that's on the sponsorship side of things. If you're looking, let's talk vetting deals now. Like, what are you seeing in the market?
Yeah.
Because again, if you
Mhm.
got into 2018, you're cutting your teeth on some deals and underwriting and that sort
Yeah.
of thing. Market has changed significantly in the multifamily space from then to
Yeah.
now. So what are you guys looking for in deals right now? Like, what
Yeah.
markets are you guys in? Just kind of break
Mhm.
it down for me. Like, what are you seeing as far as
Yeah.
returns go? Are you guys more cash on cash focused? I'm gonna ask you 50
Yeah.
questions before I let you respond.
Yeah.
Sorry, dude.
No, that's great. That's great. And I'm gonna forget most of them, and we'll
I
revisit them.
know, my
But
bad.
when it comes to deals, I'll teach you how to throw most deals in the garbage in a couple minutes right away. Just go straight to the debt portion of the investment deck. Go straight to the debt. The debt is the number one deal killer in commercial real estate. It's the biggest thing that will kill your dreams. It's leverage. It's called leverage for a reason. It's because it amplifies things. It's going to make a good deal great, and it's going to make a bad deal really freaking horrible. So we look at amount of leverage. So most investors would consider, 75% loan to be a pretty even keel area. That's pretty good. Below that, most people consider very safe. So really, the less leverage you can get on a deal, the more safe it's going to be. It might eat into your returns a little bit, but that's kind of a question you have to ask yourself as an investor: is what's my appetite for risk versus what am I looking for returns? Generally speaking, 75% or so is kind of the most that will ever go, unless something crazy special deal happens. But that's like the top level. What's the flexibility on the loan afterwards? Do you have extension options? What needs to happen for those extensions to happen? What is the cash flow on the deal? Cash flow is king, not because of that's where most of your returns will come from, but because that's how you survive. If you have strong cash flows, you can always refinance your loan. Always. You'll always have options. If you have weak cash flows or no cash flows, refinancing is very, very, very tough. And so you might not be able to outlast these deals or outlast these down market cycles. So just understand that when you're investing, most of the time your cash flow is kind of a defensive metric. The more return comes from cash flow, the more or the less risky investors will generally consider that deal. And it doesn't mean that you're going to make a killing off of your cash flows. You're generally still going to make more on the appreciation of the asset or the forced appreciation, but it's a defensive play. Cash flow is always on your side. We don't do no cash flow deals. We don't do new developments. We don't do very, very, very heavy, condemned buildings or anything like that. It's just, they're great. It's just not in our risk appetite to do those things. We don't like to feel like we're working against the clock. When you have no cash flow, you're always working against the clock. So when you have cash flow, again, it buys you time. So those are some of the big ones on the deal specifically. When it comes to the market, that's also another big thing you want to focus on. Where a lot of people are missing the beat on market is a couple of things. First is rent to income ratios. You have some of these markets where tenants are paying 40 to 50+% of their income to rent. You can't do that. That's not sustainable at all. You get a flat tire and you're not going to get your rent that month. So keeping at an absolute max about 30% rent to income ratios of where your pro forma rents are is going to be really, really big for us. You want to have tenants that have cash. Diversification of economies in that area are really big. I like to look for single points of failure, and having one big employer, in my opinion, is a single point of failure. Even if that employer is a government building or a military base or something like that, the government does shut down bases. Like, what's the one point of failure that's going to make this market useless? You got to ask those questions. And so debt to income ratios, market on there. Supply coming online. You have these white hot markets like Nashville, or now way overbuilding. They have 11% plus vacancy rates at this point, and still about 10,000 units coming online. Not 10,000, I think 1,000 more coming on this year. It's just not looking good from a supply and demand perspective on them. So if you're investing in these white hot markets, understand that that's where builders are going to. Builders are going to these white hot markets to meet demand, and sometimes they're going to overbuild. So understanding that if you are going to invest in those fields, make sure that you're kind of infill where there's not a lot of new developments near you, and you're kind of insulated from that stuff a little bit. But other than that, those are some of the big highlights. There's sheets of due diligence that we do on all these deals. I don't want to bore people with like a due diligence episode, but if you check those boxes, that's going to get you, 70 to 80% of the way there to get to having a pretty good deal.
Yeah, solid. Good advice again. Okay, so like I'm digging through some of your stuff, right? And you've got retire in 10. Is that like what you had something branded? What was it? What's it called?
Yeah. We have a package called a retire within 10 bundle. It's got, retirement calculators, pretty much see how fast you can replace your income with passive income with kind of our layout of a strategy. It's got an ebook for you to kind of read more about the strategy and kind of what's the fastest route to retiring with this type of strategy, like passive investments. And it's pretty specific. So definitely read the ebook, and it has another tracker, like an investment tracker in there. So yeah, that's, part of our shtick is how fast can you replace your income and be work optional.
All right. I'm gonna pin you down on it though. I want to know, like, give the abridged version, like how do you retire in 10 on what type of investment strategy? Because replacing, as an LP, replacing your income, you have to have a pretty big nut to go into some of these deals, I would think, to be able to retire. So
that's part of it too, right? Part of it is, you got to have money coming in. I'm not a big believer in the invest with no money kind of thing. I think that's ultra risky for people to do. I don't think it's a healthy investing strategy. So, the caveat is, hey, you got to start out with some money. You don't have to be a millionaire, but you got to start out with some cash to start investing in deals. And really the big secret that a lot of people miss is they focus on cash flow too early. Meaning, you read these things from real estate investors or from real estate influencers that are saying, hey, buy for cash flow. Yeah, those real estate investors have 7-figure checks that they're going to go make 6% cash flow on. Yeah, that's good money. It's 60 grand a year. If you go in with a $100,000 check and you're getting 6% cash flow, you're getting 6 grand a year. It's not no money, but you're not really moving them. You're not walking away at any time. Yeah. So really, the biggest secret is switch the way that you see things. Don't look at cash flow first when you're in your building period. Look at your equity gain. I'm not saying ignore it, because what I just said about cash flow is kind of a defensive play. So you want a little bit of cash flow in there, but if you're building and you don't have those big checks to write yet, you need to grow. you need to look for ways to multiply your equity. Multiply through things like value add real estate, like value add apartment buildings right now have very big multiples on equity, and grow that pot of equity before you look for cash flow. If you stay consistent on that trend, the biggest thing that you want to look for is, when do I get to, let's call it $100,000 of passive cash flow a month. If you look at the heaviest cash flowing passive investments that are the most risk adjusted, that pay the most consistent returns, because when you're living off your cash flow, you can't have distributions stop. Like, you need something very consistent. You're probably looking at a debt fund. That's going to pay you every single month. That's going to pay the same every single month. Our debt fund has not missed or underperformed on a monthly distribution since inception in 2014. That's what you want. You're going to get about 9% on that, paid every year. You need about 1.2 million bucks to clear $100,000 of passive income there. So if you don't have 1.2 million bucks, look for ways to multiply your equity until you do. That's the biggest secret to doing it fast in a risk adjusted way. Don't look at the 9% cash return if you got 50 grand. Look at that when you got a couple million bucks to play with.
Yeah.
Until then, you're in growth mode.
Yeah. No, man, solid advice. It is. You literally have to build up your nut that you can invest.
Yeah.
So that you have enough that is going to pay you on the passive side of things.
Yeah. Yep.
Yeah, because you can take $50,000, and I had a guest on and we were talking about it, and he was like, getting into one of these deals and being like a 0.001% owner of a deal is not really going to move the needle for you as much as you taking that 50 grand and you go and you buy a single family house and flip that thing, turn it into, $90,000 in 6 months. Like, that return is insane compared to, and then once you build it up enough, then throw it into something else. So I don't know if that's kind of the strategy, but
I think it is. I don't know if always flipping is the strategy, because at some point I respect people who recognize their strengths. House flipping is not for everybody. It's not for me. I don't like it. The time commitment, the risk associated with it. Generally speaking, if anybody's kind of wants a sliding scale of risk to return, the shorter term a deal is, the riskier it's going to be seen. So yeah, you could totally buy a flip and flip it in 6 months and double your money, but just know that's generally a little bit riskier than what most people would consider in like a couple of years long deal. So, recognize your strengths. If you like to do that stuff, that could be a great option. If you don't, if you want stuff passive, look at the passive stuff. Don't go buy a flip for passive income. Say, hey, the contractor will do all the work. No, the contractor is going to steal all your money if you're not there. So really understand what your strengths are and what you're willing to do, and then go into that, lay into that strategy.
I've never heard of a contractor taking anybody's money, man. I don't know.
Yeah, me either.
Well, hey, man, it's been a good conversation, Justin. I really appreciate you jumping on, sharing your knowledge, talking about your business, how you guys have it structured. I'm very envious that you are down in Costa Rica right now, enjoying the sights and the scenes. But kudos to you, man, for being able to do it and structure your business and life in a way that you are able to do that. So I'm going to put all your contact info in the show notes. So if
perfect.
You're out there and you're looking for an investment or a vehicle, an opportunity, definitely reach out to Justin and have that conversation with him and check out some of the opportunities that he has coming online.
Cool. Yeah, I appreciate it, man. I hope this was helpful.
Yeah, for sure. Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.